Well, let's get across what we can expect in this Asian session today with Kyle Rada, who's joining us from Capital.com. Kyle, good morning to you. Look, it's all about the Middle East, this conflict. We've had an escalation of the attacks coming from both sides, Israel and Iran. What are we looking for when Asian markets come to life?
I think we're looking at a fairly negative open, quite naturally. We had a negative lead from Wall Street, and we're getting a market that is not only skittish about things that it has some degree of confidence about pricing in, even if it does generate certainty, which is, fiscal policy and trade policy and central bank meetings this week, with something now that the markets find very difficult to price in, which is geopolitical risk, mostly because it's, quite dynamic, and also, very difficult to quantify when it comes to, the actual impact on asset prices. So effectively, we're going to see a little bit of risk aversion coming through the market, if nothing else, this morning. Of course, that's just simply reflecting to start with the sell-off that we saw on Wall Street. And then, of course, on top of that, the increased escalations that we saw over the weekend, which suggests that there might be more downside to price in because clearly things are ratcheting up rather than settling down. So, it's going to be a big week. Obviously, it won't all be about, sort of geopolitical risks, but, it just sort of adds something on top of, the mixture of things that are causing some degree of, trepidation in the markets at the moment, or a degree of uncertainty. So it's likely to be a bit of a negative day.
Certainly. And we will be watching energy prices, we'll be watching gold, we'll be watching currencies as well. Safe to say that the risk-sensitive Aussie dollar could continue to come under pressure if we do see this escalation in the conflict. It's a tough one, isn't it? Because, of course, we've seen pressure on the US dollar as well.
Yeah, we have, and when we did see the strikes occur last week, the US dollar, benefited from that, loosely speaking, and that was something that sort of dragged the Aussie back below sort of 65 cents. But of course, there's a lot of choppiness in currency markets at the moment because there's several headwinds. We're getting sort of a mixture of economic data out of the United States. We're getting sort of on again, off again sort of trade developments, or being drip fed some good news, some good bad news when it comes to sort of trade developments. There's the ongoing fiscal story in the United States as well, which will potentially come to a head over the next few weeks too. And now we've got this kind of bigger story at play with tensions in the Middle East, which will likely drive gold prices higher, will likely drive oil prices higher once again to kick off the week. But once more, it sort of adds to the sort of crosswinds in currency markets, which kind of means that sort of a directional bias is a little bit difficult to find. I mean, overall, the Aussie dollar probably won't perform particularly well in this environment, certainly against its other G10 peers. The question is obviously to what point, to what extent does it sort of drive safe haven flows and into where? But nevertheless, it's certainly a risk-off environment, one that sort of weighed on the Aussie a little bit, notwithstanding maybe some upward pressure on commodity prices because of what's happened in oil. And again, it's just a symptom of the kind of risk aversion coming through the market because of these issues in the Middle East.
Yes. Now, we do have the G7 meeting happening in the west of Canada. Donald Trump will be there. Our own Prime Minister will be there. Obviously, the Israel-Iran conflict will pull a lot of focus there. But there are other key economic, flashpoints that we're considering as well, and it includes, critical minerals and rare earths, which could impact some of the corporate moves here today, you'd think?
Yeah, quite potentially. I mean, obviously the latest round of trade talks between the US and China pretty much centered around, rare earth security and being able to make sure that they have the crucial parts to be able to continue sort of their, massive tech industrial complex, if you will. So, I mean, we are seeing from the Trump administration, rhetoric to suggest that they feel like they've secured a pretty good deal on that front, and that the supply of rare earths will continue to remain ample into the global economy. And obviously, those supply chains won't be disrupted significantly. The Chinese have more or less echoed those sentiments, but without, perhaps not quite as vociferously. So we're continuing to look at those areas of the market because obviously it presents a potential supply shock that could sort of flow through into the ASX 200, as well as being a little bit of an indicator of just sort of broader US-China tensions, because again, this has been kind of the latest step in that kind of process that has built momentum ostensibly to another trade agreement somewhere down the line. But when it comes to the G7, a lot of the story now is being eclipsed by the fact that world leaders have a geopolitical crisis in the Middle East that looks like it's potentially ratcheting up. There is this big ongoing question to what extent the United States will become involved, either as an aggressor or perhaps as a target, because obviously the Israelis are using, or will probably have to use, US weapons to be able to what seems to be achieve their strategic goal, what appears to be their strategic goal, which is obviously to knock out Iranian nuclear facilities. But over it all as well is the fact that we've got broader trade negotiations at play. That's going to be a key story with G7 as well. You've got some leaders there like Keir Starmer and Mark Carney, wanting to sort of shift things back to kind of an economic story, more or less. With the opportunity of more or less having Donald Trump in the room, as in the same room as them, to kind of build some kind of consensus about how trade should develop between, and trade deals should develop between these countries. Again, like we're saying off the top, it just speaks to the very fraught and complex environment that policymakers and market participants are dealing with alike, and that's not even sort of the bringing into the equation the sort of deluge of data that we have coming up this week with all the central bank meetings.
Yeah, we'll just briefly touch upon the Fed, because you've got to think that if we do see this conflict in the Middle East prolonged, and that would result in a higher oil price, that complicates the inflation picture from the Fed. Now, we know that they're not likely to do anything this week, but what are we looking for in the commentary as far as hints as to when this cutting cycle will start?
Yeah, well, the run up in oil price is very interesting because, despite the risk aversion that we saw last week when the strikes occurred, just because we saw such a significant move, there was in oil prices, that there was a big jump in the back end of the yield curve in particular, but, right across the curve. It has to be said, but in particular at the back end of the curve, really because of the inflationary impacts of higher oil prices. It'll be kind of fascinating to see over time, and not necessarily as the dust settles, but, when the kind of picture becomes a little bit clearer what the Saudis do when it comes to sort of signaling about future output, because arguably, they've been trying to put some downward pressure on oil prices for a variety of reasons, that their own self-interest, but also maybe appeasement of the United States. They've got the ability to be able to sort of step in there and take that risk off the table. So that's the next thing we'll be looking at. But when it kind of comes to the Fed and its interest rate deliberations in the coming days, there was the sense that because of the uncertainty posed by tariffs and some signs of maybe sort of persistent price pressures and what have you in previous weeks, that they might have reassessed their dot plots. Like you said before, it's not expected to cut interest rates this week, but there was the expectation that maybe they'd change their dot plots, because this is an SEP meeting this week, to reflect only the one rate cut this year. After last week's inflation data, the markets have actually increased the implied probabilities of two cuts this year to basically notionally 100%, so two cuts priced in by the end of 2025. So you've got markets really uncertain about what the Fed's reaction function is here, what they're likely to tell us at this particular meeting. The markets are basically pricing in a cut, but the Fed has taken this kind of wait and see approach, especially now that that was pretty much generated by trade uncertainty. Now they've got this geopolitical uncertainty that they're going to have to deal with as well, whether the Fed will be reluctant to give that kind of reassurance, and therefore we get that volatility when the markets start pricing in the chance that there won't be the cuts that are currently baked in. So a very fraught environment. Again, it's not going to be a live meeting, but that SCP is going to be crucial. And dovetailing into the Bank of England and the Bank of Japan as well, this commentary from central banks about how they're actually approaching the outlook and what their reaction functions are is going to be really important for how the markets actually price in the future, and whether the risk of a policy mistake, for lack of a better word, is heightened and could add to that volatility.